works. So let's quickly chat a little bit about the negatives on retirement annuities. So the first negative of a retirement annuity is that there's no access to funds. Once the fund in your retirement annuity reaches 11,000 Rand, so the maximum that's in that fund is 11,000, you can withdraw the money in your retirement annuity. But once it reaches 11,000 Rand, you cannot access the funds in that retirement annuity. It is fixed there until age 55. So a lot of people ask me, but if I've now contributed to my retirement annuity and I can no longer contribute, how much or do I lose the money that I put towards that? So the answer is no, you do not lose the money that you contribute towards that. What will happen is your funds will build up. Then if you cancel, it goes what we call paid up, that retirement annuity. So there will be penalties because the cost is calculated over the term of the investment. That penalties will be deducted from your fund value, and the rest of your money will stay in that retirement annuity until you are at least 55 years old. It will still be invested in the market, so you will still receive the returns on the investment that you have put into the market. And then when you get to age 55, you will be able to access those funds. And that is the second thing about the retirement annuity. The earliest you can access your funds in your retirement annuity is age 55, which is early retirement age. So then only can you access the funds in your retirement annuity. But what happens if you have a paid up retirement annuity? You have 200,000 Rand sitting in an RA and you are not contributing towards it anymore. And now you want to start a new retirement annuity with another company and you want to start contributing again. What are your options? So your first option is to just leave the money where it is because it is invested in other funds than what you potentially would invest in the new fund, which means you've got some diversification in your portfolio. But you can also choose to move those funds from that old retirement annuity into the new retirement annuity. So instead of you starting at zero, you're now starting at 200,000 Rand to invest, and you then just contribute on top of that. That is what we call a Section 14 transfer, and it is a allowed transfer in the industry that you can move from one fund to another fund. Just keep in mind that it takes time for these Section 14 transfers. So your financial advisor, don't get upset with them if it takes 3 to 6 months for this money to be transferred. It is quite a timely process. And it's not the financial advisor, not the broker's fault. It is usually the industry or the companies that take a long time to do these transfers. Inside your retirement annuity, you are invested into different funds inside. So you could have 1,000 Rand a month going into your retirement annuity, but you might have 4 different funds inside. So it might be invested into an income fund, there might be some property investment, there might be some equity and some bonds, and maybe some gilt funds or something like that inside your retirement annuity. So, and your fund will grow by the combination of the growth on each of these different funds inside your retirement annuity. Now, you are allowed to shift between funds in the retirement annuity. So let's say, for example, your bond fund is not performing well and you feel that you want to move it. You can move the money out of that bond fund into another kind of fund or another fund in the same sector. So there is that flexibility. Just be very careful, guys, that most of the time these moves, you don't want to move your money and try and stock pick. You don't want to try and pick funds to go in trying to ride the waves. When you look at a retirement annuity, it is a long-term investment. You want to go into funds that you choose and stay in those funds for as long as possible so that you can get the compounding effect. because every time you move funds, you get hit by the buy-sell spread in a double whammy. So let me quickly explain what the buy-sell spread is. Whenever you buy units in a unit trust, or you buy shares in a share, or you buy Forex, for example, the amount you pay to buy that unit and the amount it is valued at that moment to sell it is not the same amount. Your buying price will always be higher than your immediate selling price of that specific unit. It is like buying a car. If you walk into the dealership, you buy your car for 100,000 Rand. If you walk out and you try and sell it back to that same dealership immediately, they're not going to give you 100,000 again. They'll give you 90,000 Rand. That's what they call the buy-sell spread. So what happens is, let's say, for example, your difference between your buying price and your selling price is 5%, just for an example. So you move your money from one fund and you're going to move it into another fund. That buying price is 5% less than what you're selling. That selling price is 5% less. So you're losing out on that. Then you go and buy in the new fund, and that's 5% less again. So you're basically losing out on about 10% with that move from the one fund to the other fund. So be very careful when you're looking at moving your fund so that you don't get bitten by the buy-sell spread. But you can move the funds from one fund to another fund. Another thing that's important is, guys, be very careful when advisors, brokers come and tell you to cancel a retirement annuity to start a new retirement annuity. More often than not, I would say over 90% of the time, the only person that benefits from cancelling one retirement annuity and moving it to another company is the advisor. It is not in your interest, it's in the advisor's interest, because he's getting to sell you another policy, which means he's getting commission on that policy. Be very, very careful of that, because what you cannot buy back is the time that you've invested in that product. So you lose that time that you've invested, and secondly, you're duplicating these initial costs of your investment, which negates a lot of the compounding interest effect that you might have received. So guys, if an advisor comes and sits with you, and all they want to do is try and move everything that you've got with one company, and we all know the D company that I'm talking about. So they all want to move everything into this one company, because if you have everything there, you'll get this bonus, and you connect this to that, and the knee bone gets connected to the thigh bone, and everything is all connected, and now it's in your benefit. Be very careful. It is more often than not, it is not in your best interest. It's in the financial advisor's and the company's best interest. So really, really do your research. Get second opinions. Make sure that what you are doing is right for you. And that is why it's so important to educate yourself. You cannot be successful at investing, at building assets, if you are a passive investor. You cannot be successful if you don't know what's going on with your own money. You need to educate yourself so that you can become an active investor. I'm not saying don't invest in retirement annuities. Don't invest in structured products. I'm saying teach yourself, get enough information so that you can do it on your terms and not the advisor or the company's terms. Okay, so that is the retirement annuity. So another thing is, on a retirement annuity, when you do retire from the fund, you have limited access to the funds. So you cannot just take your money and go and invest it and buy 3 properties. You can only access 1/3 of your money as a cash lump sum, and 2/3 of your money has to be invested into an annuity, which we will be talking about now. So you can't just do with your money whatever you please. At least 2/3 of that money has to be put into an annuity. The 1/3 will be taxed. There is a tax-free portion. The first 500,000 Rand is tax-free, and over and above that, you will be taxed on that. And the 2/3 that goes into the annuity will be taxed as an income in your hands as you were receiving income at the moment. So the same tax laws that you are paying tax on your income at the moment will still work when you are retired and you're drawing income from an annuity. Another big thing with retirement annuities is that your retirement annuity always has to stay Regulation 28 compliant. So what does that mean? What that means is that you can't just put all your money into equities, for example. You are limited to how much money you can put into different funds or different sectors of the market. That limits your flexibility, which means you can lose out on great spikes in the market. So, for example, over the last year or so, after the COVID dip that we had, some of the equity funds have grown by 40-50% over the last 12 months. But through your retirement annuity, you cannot be 100% invested into equity. The maximum you can invest into equities are 75%. The maximum you can invest into property is 25%. The maximum combined between the two is 90%. So you can't have 75% in equities and a full 25% in property, because that will constitute 100%, which is not allowed. So you have to drop your equity if you want some property fund investment there as well. So there's all these regulations that limit you on the growth, and it's one of my pet hates is Regulation 28, but I don't have time to really go into why I feel Regulation 28 is a very negative thing for investors in retirement. Okay, so those are some of the negatives on your retirement annuity.